Hello and welcome to this video. For those of you who are new to this channel, I'm Dr. Subayal Khan. I'm a business strategist, experienced investor, award-winning scientist, and also help the business owners as a coach and sales mentor. In this video, we will evaluate Pfizer, stock ticker symbol PFE, as a long-term value investing. So Pfizer has been a lot in the news lately due to their COVID vaccine, but looking at the broader picture, the company is one of the leaders in developing drugs and vaccines and innovations in this domain. So according to Wikipedia, Pfizer Inc. is an American multinational pharmaceutical and biotechnology company headquartered on the 42nd Street in Manhattan, New York. The company was established in 1849 in New York by two German immigrants, Charles Pfizer and his cousin Charles F. Enhart. Pfizer develops and produces medicines and vaccines for immunology, oncology, cardiology, endocrinology, and neurology. The company has several blockbuster drugs or products that each generate more than $1 billion in annual revenues. In 2020, 50% of the company's revenue came from the United States, 8% came from each of China and Japan, and 36% came from other countries. Pfizer was a component of the Dow Jones Industrial Average Stock Market Index from 2004 to August 2020, which is a big achievement. The company ranked 64th on the Fortune 500 and 49th on the Forbes Global 2000. So there has been a lot of hype around the Pfizer stock due to their COVID vaccine and so on. So now let's dive deep into the key value investing dimensions that I look for in a stock before making it a part of my long-term value investing portfolio. So the current price of Pfizer stock is $48 US. The market cap is $266 billion US. The PE ratio is 20.1. The PEG ratio is 3.8. The earning per share for the trailing 12 months is 1.71, and as we can see, the PE ratio and PEG ratio are also for the trailing 12 months. The price to book ratio is 3.6, the price to sales ratio is 5.2, and the price to free cash flow ratio is 16.9. The average revenue is minus 4%, the average asset growth is minus 2%, the average equity growth is minus 3%, the average net income growth is 17%, and average liability growth is minus 1%. And all these numbers were computed over a time frame of 10 years. So let's have a look at the shorter time frame of 5 years. So over the last 5 years, the average revenue growth has been minus 2%, the average asset growth minus 1%, average equity growth 0%, average net income growth 31%, average liability growth minus 2%. So that is the situation over a time span of 5 years. And now let's have a look at even the shorter time frame, the 3 years. So over here we can see that the average revenue growth is minus 7%, the average asset growth is minus 3%, average equity growth is minus 4%, average net income growth is minus 14%, and average liability growth is minus 3%. And over here on this graph, we can see that the average revenue has been declining year over year from 2010 till 2020, more or less, except for 2016 and 2017, where it was more or less the same for both these 2 years. But actually, we saw a rise from 2015 to 2016. And then, as I said, it remained almost the same for the year 2017. Then we came down, and then there is a slight uptrend now in the last 3-4 years. So here is the situation again over a time span of 5 years. So 2010, 16 and 17 revenue remains more or less the same. But then there was a decline from 2017 to 2018. And since 2018 till 2020, we are again seeing a steady upside. And now looking at the total assets over total liabilities, which is fundamentally important. And also at the total current assets over total current liabilities. So looking at this blue graph, which shows total assets over total liabilities, we can see that it always stays above 1, which is very important for me to look at before investing in a company. And also the total current assets over total current liabilities, most of the times they stayed above 1. But here in 2019, there was an anomaly where it dropped to 0.9, but after that again it has risen above 1. And here is a zoom in picture of the previous graph over the past 5 years. And we can again see that the total assets over total liabilities always stay above 1. But except for 2019, total current assets over total liabilities have always stayed above 1. So 2019 was the only exception. And now here's the further zoom in of the previous graph now for the last 3 years instead of looking at the whole of 5 years. So again, we can see that total assets over total liabilities and total current assets over total current liabilities always stays above 1. Only 2019 stays as the exception, as I already mentioned. And now let's have a look at the three important ratios, which are PE ratio, price to book ratio, and price to sales ratio. The ratio in which I am interested the most is PE ratio, but of course you can pause the video and look at other ratios if you are interested in. So looking at the PE ratio of a company, I want it to be below 20 if I am going to make it a part of my portfolio, except for those companies which are in the very beginning phase and are very innovative or are going to create a blue ocean from scratch. So in those companies, okay, they are very high risk plays. So over there, I will rather look at the PEG ratio more than the PE ratio. But you got the point. These dimensions which I present over here are more like guidelines. It is a disciplined approach, but we need to have good diagnostic skills also. So nothing is set in stone and one size doesn't fit all. So let's continue our analysis of this stock, which is of a company that is very well established and has a long history. So we can see that in 2015 and 2016, the stock was a no buy option for me because the PE ratio was 27 over there in 2015 and it was 25 in 2016. In 2018, again, the PE ratio on average was 21.20. Again, a no-go area for me for this stock. And again, in 2020, the PE ratio is 21.31. So I will rather wait for the price to correct, and we will look at the price chart later on when we will look at the market state. Now, in 2013, as we can see, the stock was on sale because the PE ratio was just 8.44, and same is the case for 2017 where the PE ratio was 9.63, and also if we look at 2019 the PE ratio was 12.62. Wow, these were some amazing years to accumulate this stock and make it a part of our long-term portfolio. So this is how value investing goes. We have to be very patient. We have to look for a price where we are confident that, okay, fine, the value which we are getting for what we are paying for the stock price is good enough. It is worth buying the stock for that price because the value which we are going to get by buying the stock is going to be way higher. Once again, so basically this graph shows all the three ratios over a time frame of 5 years. So this is a zoom in of the previous graph. So we have chopped it up and then we zoomed into that to look at the last 5 years. And over here, we have again zoomed into just the last 3 years so that we can see those ratios over that time frame. The key growth rates, for example, the total asset growth, the total liability growth, and the total equity growth has been all over the place. I mean, there is no fixed pattern that we can see over here. So basically, the total equity growth, it has been negative in 2011, in 2012, in 2013, 14, 15, 16. In 2017, it became positive and it was 20%. In 2018, however, it is minus 11% again, and in 2019 and 20 it is 0%. And also if you look at the total asset growth, so in 2011, 12, 13, 14, then in 18, and then in 2020 it has been negative. The only years where it has been positive was 2019, was 2017, 2016, and that is all about it. And if we look at the total liability growth, so in 2011 it was negative, in 2012 it was negative, in 2013 it was negative, then in 2017 it was negative, 18 it was negative, and in 2020 it was again negative. The only years that it has been positive or growing is 2015, 2016, and 2019. So this is how the growth in total assets, total liabilities, and total equity has been over the last 10 years for this stock. Now if we look at the return on equity and return on invested capital, which actually tells us how efficient a value creation machine a company is, we can see that, okay, fine, over here, even though we are not getting some really high numbers like 40, 50 or something around that, and mostly it has stayed below 30%, but still, okay, the situation is much better over here. And we can see that in 2010, in 2014, at 2015, 2016, and then in 2020, the return on invested capital was less than 10%, which is quite low. But then again, in some years like 2013, in 2017, and then in 2019, it was over 15%. So these years were quite good. And the return on equity graph is not much different from the return on invested capital graph. It very closely follows the return on invested capital graph, as we can see over here. So for each year, the percentage of return on equity is more than return on invested capital by around 4 to 7% for all these 10 years. And then if you want, you can pause the video. You can have a look at these two ratios over a time frame of 5 years and also over a time frame of 3 years. Now the operating margins over here are quite okay. The same goes for EBITDA margin and the same goes for gross margin. So the operating margins have stayed over 20% most of the time in the last 10 years, and the EBITDA margins have stayed over 30% for most of the time in the last 10 years, and the gross margins have stayed over 70% in the last 10 years, as you can see over here. Same was the case for the last 5 years, but if we look at the last 3 years, the operating margins are just very close to 15% most of the time, while the EBITDA margins are pretty close to 30% most of the times, and the gross margins are between 78% and 79%, around that range in the past 3 years. And now if we look at the diluted shares outstanding, so the number of shares available for purchase on the market is decreasing. Same is over here in the last 5 years, and same is the case for the last 3 years. And now let's have a look at all the 14 value centric investing dimensions. So we can see over here that over the past 10 years, when we ask ourselves a question, is the revenue growth at least 15%? The answer is no. Are the net profits on average staying over 10%? That is okay. The average ROE is over 15%. Yes, that is true. The average ROIC is over 15%. No, that is a fail. The PEG ratio is under 1. Yeah, that is a pass, because many analysts, in my opinion, believe that, okay, fine, the company has a lot of room to grow because Pfizer is a very innovative company. And then just like the PE ratio, the price to free cash flow is also very important. So is the price to free cash flow on average less than 20 during the past 10 years? The answer is yes. The earning per share growth is at least 10%. That is a pass, which is a good sign. The earning per share growth is at least 10%. That is a pass, which is a good sign. Equity growth is at least 10%, which is fail. Is free cash flow growth at least 10%? That is a fail for a time span of 10 years. Is operating income growth at least 10%? That is a fail. Average share dilution is not over 3%. That is a pass. Actually, we can see that the number of shares which are available for purchase on the market are actually decreasing. Are current assets greater than current liabilities? That is a pass, and that is very good because it shows the financial strength of the company. Is ROE staying the same or going up? Pass. Is ROIC staying the same or going up? Pass. So it simply means that the management is doing quite well still. Now if we look at the past 5 years only, not the 10 years, we can see that when we look at the same 14 dimensions, the score comes up to be 71%. In the last 3 years, however, the score again drops to 64%. So feel free to pause the video and look at these dimensions over the past 3 years over here and over the last 5 years over here. It will also help you in doing your own research, because this is what this channel is all about. And now after looking at the value investing dimensions, now it is the time to go to tip ranks and look at the current state of the market and see some key dimensions over here. So let's go ahead. So over here we can see that according to the analyst's opinion, it is a moderate buy, and the blogger's opinion is quite bullish. The news sentiment is also bullish. The hedge fund activity is increasing. The insider activity shows that they are selling the shares, which is not a good thing. So tip rank is very good in the sense that it gives you state of the stock over a time span of 12 months. Over here I can see that the stock is very overpriced. It has gone up quite a bit now. And for me, I will never catch a falling knife. I will let it correct. So I will always look at the value that I am getting for the price that I am paying for the stock. Okay? This is how the value investors work. And here is the beautiful graph, the hedge fund activity. So we can see that it remained pretty much constant from June 2019 to September 2019 to December 2019. And then we can see that as the price was going up, the hedge funds actually dumped their stock, and then just look at the price. It plummeted And now again, you see the hedge fund activity is pretty much on the lower side, and they are waiting for the price to correct. When the price will correct, they will again accumulate. So just look over here. From here till here, the hedge fund holdings have gone down tremendously. And now they are just simply waiting for a good opportunity to buy the stock again. So this is how I read the things. Now let's compare Pfizer to similar stocks. So here we can see that it has a PE ratio of 20, which is quite good as compared to the other similar stocks over here. But we can see that for most of these similar stocks, the PE ratio has gone up considerably due to the recent hype in the media about the biotech stocks, or let's say, and over here we can see that according to analyst consensus, it is a moderate buy. But I will simply not buy the stock right now. The reason for this is that the price is just too high and I will like it to correct. So actually Pfizer is doing quite well as compared to the stocks that are similar to it. And as I mentioned already, the price has just gone up too high. So I will like it to correct. And when it is corrected and when it is on sale, then I will accumulate again. So over here, when we look at the current market state, we simply see that it is not the right time to press the trigger, even though the company has a long history. And I believe in the company. The company is really good. It is very innovative. But as a value investor, I'm simply not gonna pay this much high price for this stock right now because the value that I'm getting in return is not that high. And I don't want to be caught up in the hype because of the COVID-19 pandemic, and some of the leading players in this domain are developing their vaccines and so on. So all in all, my conclusion is that, okay, fine, the stock is good, but it is not the right time to buy. I will wait for the correction and then I will start accumulating. So please let me know in the comments below, what do you think? Do you also believe that it is a good long-term investment? Do you think that it is the right time to buy also and to accumulate slowly? I will be looking forward to your comments down below. And thank you very much for your time. Please let me know in the comments below if you would like to watch such content again. And I will see you in the next video. Bye.